Hey Josh, yeah, Amazon stock been trading on both sides of the flat line after this report came out. So I'm going to give you the high level numbers here. Amazon reporting revenue of $167.7 billion. That was against a street estimate of $162.1 billion. So a beat on revenue there, also a beat on earnings per share. Amazon posting adjusted earnings per share of $1.68 against a street estimate of $1.32. I do want to read some other key metrics for you here, Josh. So the second quarter operating income, that came in better than expected. Amazon posting second quarter operating income of $19.17 billion, above an estimate of $17 billion. But key metric here that I think has maybe perhaps held the stock back, reading through the report, I would have thought maybe up. You take a look at the third quarter operating income guidance, pretty wide range from Amazon here. Amazon with a range of $15.5 billion to $20.5 billion for operating income. Of course, that's perhaps where maybe tariffs could come into play, right? The street was looking for an operating income in the third quarter of 19.42. So Amazon with a wide range. The low end range of that third quarter operating income is lower than what Wall Street had hoped for.
And Jeff, I want to bring you here as well, because I think you hold this one. Another metric is AWS sales, of course. That's what folks are going to make a beeline for. It looks like AWS net sales XFX plus 17%. That is smack in line with estimates.
Wow. Okay. No, yeah, AWS is where my attention goes to all this. That's the growth engine for where Amazon's going to go. They obviously, I'm assuming we'll find out in the actual text, but with that wide range, I'm assuming they're building in some tariff concerns, especially around there on the low end.
They have also, I remember, Jeff, too, and it'll be interesting how they comment. I remember they've also talked about in the past being, on AWS specifically, being capacity constrained, and I wonder if that's another issue that'll be brought up.
Well, that's an issue with all AI, right, of capacity from a power perspective, and just getting the products here to continue to build and grow it. I expect AWS to continue to be the growth engine. They have some headwinds there, obviously, like we've touched on a little bit, but that's a great number for me. And I definitely want to dig into that forward-looking guidance of what they're worried about.
I also wonder, to the extent that, obviously, now this is the last of the cloud giants to report. We had Google, we had Microsoft, and then Azure print, which really impressed people. I think it was 39% maybe. And I wonder, if that was set some type of bar for them as well, AWS. Yeah,
it's tough if you're not the best looking girl at the dance. And that's where kind of Amazon might be coming in here, right? Next to Microsoft, it looks bad. In a vacuum of totality with Amazon, though, it's a good number, but compared to Microsoft, I can see why the street might react negatively.
What do you think, Josh?
Yeah, well, I think when you think about that Microsoft Azure number, I mean, we were talking about this on the morning show this morning, to surprise Wall Street by over 4%, like Microsoft did yesterday, they hadn't done that in over 2 years, right, for that Azure growth. So to see acceleration in that part of the business is a huge story for Microsoft, and it just sets perhaps a high bar for Amazon. And you also brought this up earlier, Jeff. I mean, the stock was already up 2% today, too, right? Yeah. So we're looking at a stock that's essentially trading almost flat over the last 24. Like, it hasn't moved a lot, and it's certainly not selling off. I think this is a company where you definitely want to hear more on the call, especially when it relates to AI and what is AI doing for AWS, right? That was a story Microsoft told very well last night on the call.
Amazon reporting a beat on earnings and revenue for the second quarter, while its key Amazon Web Services segment saw sales increase 17.5% year over year. Here with a closer look is Wedbush Securities Managing Director of Equity Research, Scott Devitt. Scott, great to see you, sir, as always. So Amazon reports, Scott, the just at least initial reaction in the after hour, Scott, we got the stock down about 4%. What do you make of the results?
They're good. I mean, I give it a B+. I'll tell you what's good and then why the stock's probably down. The retail business overperformed healthily. Advertising was very strong. Operating margin beat by 13%. And then AWS, 17.5% growth is healthy, but because of the overperformance of Google's cloud business and then Azure, whispers were kind of creeping up towards 18, 19. So it's not a miss relative to analyst expectations, but relative to buy-side expectations, going into number, maybe that was a little bit light. And I think that's why you're seeing the response in the stock.
So you think it's a compare and contrast story right now, Scott? The bar got set high by Microsoft, by Alphabet?
Yeah, it's like being the cleanup hitter and having the first three batters hit home runs in front of you. The bar's rising, and then you have to do something even better. And in the case of Amazon, it was a good AWS quarter. But if all you're going to focus on is AWS and you look at the prior reporters, most notably Microsoft and Google, their results for the 3-month period were better, relative to expectations. And so there's nothing wrong here, but it's just an expectations, miss in that regard for a stock that has been relatively strong in recent weeks.
Can I ask you, in that big cloud fight, Scott, now that you've heard from all three, Microsoft, Alphabet, Amazon, what are Amazon's competitive advantages there?
So like Azure has, a lot of affiliation with OpenAI ChatGPT, which helps the revenue of the business. Amazon's tied to Anthropic, which is smaller but starting to grow and will be a more significant contributor in the second half. I think the moat that Amazon has, which is the question that you had, is that they are the legacy leader in providing the services. So as they layer AI into their product portfolio, as they've done, their customer base gravitates towards that and they continue to grow. But it's a battle. There's three very good companies, going after this cloud revenue. And Amazon had it kind of all to itself for many years. And now, Azure looks like the prettier girl at the prom, if you will, at the moment.
Let me ask you, Scott, about this other metric here. They did project operating income in the current quarter. I don't know if it fell short of your estimates. It does look like it did fell short of consensus. Operating profit's going to be between 15.5 to 20.5 billion. It looks like in the period ending in September. I'm just curious what you make of that data point, that metric, Scott. Is that perhaps worrying folks? Well, maybe they're turning on that spending spigot just a little too hard.
It shouldn't. I mean, the CapEx year to date is 57 billion, so they're probably going to ultimately do more than the 105 billion for the year. But the reason why that guide is not an issue is that Amazon's been exceeding the high end of their guidance for many consecutive quarters. In fact, it guided to the second quarter of, I think it was 13 billion to 17.5 billion and just did 19.2. So when you look at that guide in respect to what it just did relative to its prior guide, you conclude that estimates are just fine. It's just the way that Amazon guides. They put a low hurdle out there to beat. So if that's driving, some of the underperformance after hours, that's a non-issue. Where I think the core focus is, to the extent that you're matching, stock price performance to where actually there was disappointment, it had to be in that AWS number.
And when you model out the AWS growth and margins from here, Scott, what does it look like?
I mean, this is a business that can go 15% plus for many years. I mean, Andy Jassy has talked about the fact that only 15% of workloads, are in the cloud still. So while it's a very big business, if you take their quarter and annualize, it's a $120 billion run rate business. That's significant. There's still a long way to go just in terms of taking in-house IT and turning it over to the cloud. And then when you overlay AI on top of that, that's tens of billions of dollars of revenue opportunity. So this is still a very strong long-term growth story with low to mid 30% margin and a big contributor to Amazon's value, in the future from here. The thing with Amazon, as a stock now, because they're in like three somewhat distinct businesses in retail, advertising, AWS, and when they report in the earnings season, when others report in front of them and expectations get set, they kind of have to hit the trifecta. And they were like 2 for 3, today. And it would have been better had the company exceeded the AWS number, because that's where more of the incremental value is perceived.
How, Scott, should we as investors think about potential tariff implications for Amazon?
So that's manageable. I mean, the merchants, to the extent that there are implications, merchants will eat some. Amazon will take on more 1P inventory and be more competitive in price. The tariffs have proven to be less aggressive than initially thought. And so there are workarounds in ways that, you almost don't see it in Amazon's results as you haven't seen it yet in the second quarter operating profit, and with the way that a company guided it, I don't think it's really going to be relevant unless this changes again. But the way tariffs are looking right now, I think it's more of a non-event.
We talked retail, we talked cloud. What about that advertising segment, Scott? I'm curious what you see ahead.
Oh, it's amazing. I mean, it's a $60 billion business now, doing probably close to a 60% operating margin. So they're in third place, but a very strong, third place behind Alphabet's business and Meta's business. And that's also a line item that's very high margin that should be able to grow 15% to 20% for some time, because you have the layering on on top of the retail business, which they benefited from for some years now. But you also have the opening up of the video platform and off-platform opportunities that advertisers can now attract with Amazon. So that's a 15 to 20% grower for many years ahead, outside of years when we have recessions.
Scott, always great to see you, my friend. Thank you. Appreciate it.
Thanks, Josh. Appreciate it.
Q3 EPS looks like 157 versus estimates of 143. I see revenue 94.04 billion versus an estimate of 89.3 billion. It looks like iPhone revenue 44.58 billion. That is also a beat. The street was at 40.06 billion. Josh Schaefer, looking at you, what do you see in these results as well?
Yeah, Josh, I mean that iPhone beat really popping off the screen to me, right? To see iPhone revenue coming in at almost 44.6 billion, and that was above the street estimate of 40.06 billion. Also some other beats across the revenue spectrum here. I'm looking at Greater China revenue coming in at 15.4 billion. That's above a 15.2 billion estimate. Then you go down to products revenue overall, that coming in at 66.6 billion, above a street estimate of 62 billion. Again, that smaller Mac revenue segment coming in at 8 billion, above an estimate of 7.3 billion. So it seems like some of the key products for Apple here driving better revenue than the street had expected. Stock was initially up 3%, Josh, right as this release crossed, coming down a little bit now, up about 1%. But that seemed to be the instant read through. Of course, we don't have guidance from Apple in this release. That's kind of one of the key questions that I know I was seeing from analysts moving forward is they're getting a lot of client inbound about where margins are going to be in the coming quarters and sort of the tariff story that relates to those margins, right? What happens to margins in the out quarters is a key question that there's no real insight to, at least in the release.
Yeah, on the call for sure. I think you're nailing it. And that'll be a big, how do they address the guidance, how they talk about the forecast? That'll be a big focus. Tariff impact as well, Josh, is going to be in focus because you're looking for more clarity there. They did say last quarter, remember, to expect a $900 million impact, but what does the impact look like in the quarters ahead is another key question that's going to come out on the call.
It absolutely is, and I think it's going to be interesting to hear how they're able to walk you through that part of the process because, of course, the tariffs themselves are such a moving target, right? So where that range ends up being and how they're able to explain that seems like a key piece here. Of course, again, we're talking really about margins, specifically when we're talking about that part of the line item. That's going to be where you're looking to see how much are tariffs impacting margins moving forward, and we'll have to see, I guess, really on the call.
For more on Apple earnings, we have Angelo Zino, CFRA Research Senior Equity Analyst. Angelo, it is great to see you as always. Those Apple's results just crossed. Your reaction to the report, Angelo?
Yeah, Josh, thanks for having me. I'd say overall the numbers were pretty good, right? But the question isn't necessarily about the quarter. It's kind of about the guidance here for the September quarter, and maybe to the point that you guys had just talked about. What is the outlook thereafter? And what I would say is, there was likely some sort of pull-in effect here that went on in the June quarter, given that we saw such strength almost across the board as far as the product revenue is concerned, and likely that had some impact due to the uncertain tariff landscape at this point in time. So again, it really is going to be dictated on what happens, what Tim Cook has to say on this call as far as what that forward guidance is going to look like.
Angelo, you mentioned tariffs. That is a key question here. I mean, as you try to model this and forecast, what do you think that financial impact could look like for Apple in the quarters ahead?
So here's the issue. Nobody really knows, and I don't think Apple knows themselves. And the problem right now is, and a big reason why they're probably going to provide limited guidance here for the September quarter. I wouldn't even be surprised if they avoided guidance on potentially the revenue or the gross margin side of things. Listen, there's a lot going on here over the next 5 to 6 weeks for Apple, right? I mean, you kind of look into just the month of August alone, you've got likely some sort of clarity from the 232 pending semiconductor investigation, where that's really where the tariff situation hinges for Apple. And whatever number comes out of there, is it 25%, is it 50%, what have you, is going to partly dictate what Apple is going to be penalized here, at least on the tariff side of things. And then the other issue is, as we progress into September, what does Apple do from a pricing perspective if we were to see higher tariffs from this 232 semiconductor investigation? Our belief is they're going to look to offset that. So you're probably going to see some sort of pricing hike if you see these higher tariffs. So, our view is they're going to try to sustain some of those margins. But again, it's tough to really know. Right now, we're pegging in about a 25% expected semiconductor tariff, and likely, some sort of, $50 bump up or what have you in terms of pricing with the iPhone 17 cycle. But listen, it's very fluid in nature. We just don't know the details at this point in time. And Apple themselves, the bigger problem, doesn't know as well.
So when you think there could be price hikes, Angelo, for those new devices in the fall, have you tried to put a number on that? What kind of hike we could be looking at? Quantify it?
Yeah, I mean, like I said, we're thinking potentially, and this is important, right? When you look at Apple specifically, they haven't increased the base price of their iPhones, right, since the iPhone 12 cycle. The reason they did increase the price on the iPhone 12 cycle was because of the move to 5G. 5G has significantly higher content costs attached to it, and as a result, they were able to pass through those higher prices to the consumer. It was expected. Over the last couple of years, they've done a number of things to avoid any type of price hike. We think it's probably going to be something along the lines of, let's call it about $50 or so across the board. It could potentially be more than that again if the tariffs are higher than we anticipate. So, again, it's very uncertain in nature. But the fact that Apple historically has tried to prevent these price increases to the consumer is very important. I think also Apple wants to make sure the optics doesn't look bad with all of this, right? I mean, you've got a Trump administration at this point in time that probably is looking very closely at some of the moves that Apple as well as others are doing, whether or not they're passing on these higher costs to the consumer. So Apple wants to avoid any sort of bad optics at this point in time as well.
A key reason, Angelo, stocks in the red this year heading into the print has been some disappointment over the company's AI position and role and strategy. How, as an analyst, are you thinking through that dynamic?
So that's a good question. And to be honest with you, I mean, I think that's probably the biggest reason for the share underperformance at this point in time year to date. I mean, when you think about what else is going on across the markets, across the tech space, it's very difficult to justify owning an overweight position in Apple when you've got these great stories going on across the rest of the tech space. But I think what you do have going for yourself here is we're going to get some good clarity here over the next couple of weeks across a number of uncertainties, whether it be tariffs, whether it be the pending search monopoly case that Google is going through. We expect some sort of outcome in August as well. When you look past that, I think the street starts looking at what Apple can do as far as AI is concerned. They have to get this right, I'd say, at the very latest by the next developers conference next June. So we expect them to figure this out at some point here over the next 9 months or so. They've got all the money in the world to throw at this. My guess is they probably get this thing done via some sort of partnerships because they've lost some great talent here over the last couple of weeks and months. So again, it's something that the street is really kind of hanging on at this point in time. But we're believers here of the management team. We think they get this thing somewhat resolved here over the next 6 to 9 months.
Final question, Angelo, in terms of what could be coming. We do have reports, Angelo, maybe a slimmer iPhone model could be on the way this fall. How excited should investors be about that?
Yeah, I mean, I'm not overly excited about it, to be honest with you. We're actually going into the iPhone cycle, essentially assuming very low to no unit growth on a year-over-year basis. So, maybe there's some excitement towards that device, but overall, it's not something where we think consumers are going to rush to upgrade. But yeah, I mean, at this point in time, in terms of on the unit growth side of things, we're not looking for any type of growth for the iPhone 17 cycle versus 16. Where we are more excited about is the potential iPhone 18 cycle, where they can start unleashing something along the lines of a foldable device.
All right, with the stock up 2% right now in the after hours. Angelo, thanks as always, sir, for that instant analysis. We appreciate it.
All right, thanks for having me.